All right, everybody, welcome back to another episode of the Dividend Journey here on Financial Friends. I'm very excited to be back, and I hope that you are too. If you want to go ahead and support the channel here at the beginning of this video, just hit that like button down below. It helps share the video to more people, boosts the video within the YouTube algorithm, and pushes it out to a whole new audience, which is what I'm trying to do here. Trying to grow to 1,000 subscribers, past 1,000 subscribers, and just help as many people as I possibly can, creating a safe space for finance here on YouTube. So go ahead, hit that like button if you want to share in that journey as well. And let's go ahead and get into this week's episode. We have some important things to cover in the world of dividends. So first thing is first, the portfolio. I know you all want a little bit of an update. Yes, we went ahead and bought some stocks this week. We boosted our annual income from $8.17 to this $9.35 that you see here. And we boosted our dividend yield from a 2.29% up to a 2.36%, which, if you are new to the dividend journey, we are trying to hit $25 of annual income by the end of this year. And we're trying to hit a 2.5% dividend yield once we get to, year end as well. So I'm very excited that we're continuing to chug along on those goals. Now, how did we do that? How did we make those increases? We went ahead and added $5 of Apple. We added $10 of O, and we added $25 to SCHD, helping us hold our ETFs within that 50% or more allocation, which I am very excited that we are continuing to stay within that realm. Now, the video title, the reason you're here to watch this video, is to learn a little bit more about dividend yields, how to avoid the kind of traps that companies might put out for investors, and what to look at in terms of dividend growth over time. This example here is something you want to stay away from. This is not financial advice. This is not investment advice for the remainder of this video. Do not invest, buy, sell, hold, trade any of the stocks I'm talking about. Because I talked about them, please do your own research. But Chimera Investment, Dividend Yield and Safety in Focus. This article was sent to me by @CTS Shah over on Public, or Chris. I'll go ahead and leave a link to his Public down below. Go ahead, check him out over there. Absolutely fantastic. But he sent me this video, or this article rather, and I found some pretty important things to share with everybody. The first thing is this 9% dividend yield. A lot of newer investors get enamored by a big number yield that's promised by a stock. So if you put in $100, the stock's going to yield you X amount, and then you're going to get this money, and you can do this with it. And almost all of the time, these bigger dividend yields are something to look more into. The saying, it's too good to be true, often holds true in investing as well. So why is the dividend yield 9%? That seems a bit high to me. Go ahead and take a look. Find out why it's 9%. Well, first thing we could find out is that they're paying out over 100% of the earnings they have. So we talked about this in a previous video with payout ratio. How can a company buy back shares, reinvest, research and development, improve tools, any of these things, if they're paying out more money than they're making? Well, they can do that by keeping a payout ratio 20% above organic earnings, which is not good, and having a dividend yield that fluctuates and dividends that flatline like this. So again, there are reasons why the yield is 9%. That's because they haven't paid or increased their dividend consistently over any span of time ever. You could see back here to 2012, 55 cents. Oh, great. Oh, that drops down to 45 cents. Then it flatlines. Oh, now it's $1. Great. Yay. 9%, 20 million percent dividend yield. Oh, back down to 45 cents. 45 cents, 45 cents, 48 cents, 50 cents. Riding the wave of 50 cents. Oh, and now it's 30 cents. There's something to be said for consistency and year-over-year growth and continuing to improve upon something that is working and not try and do something like this. So if you can see my mouse down here, this big peak. Look at Coca-Cola, an absolute kingpin in the in the investing world, look at that dividend. Right up. Okay? This is important because, again, if you're building a dividend portfolio, if you're investing in a company for a dividend, you want to be rewarded with consistency. You want the company to have proven themselves and to show that they will pay 25 cents. Then they'll bump it to 28 cents. Then they'll bump it to 30 cents. Then they'll bump it to 33, then 35, then 37, then 39, then 40, then 41, then 42 cents. You could see the consistency. You could see the growth. And this correlates. This has something to do with, again, the quality of the company behind your stock. Look at Coca-Cola's performance. Over, let's see, this goes back to 1982. Let's just even look in the last 5 years. Started out here at $41 and now up here at $60. And they've even spiked up, pretty high up here in the 60s. Again, and then they dipped, but they continue to claw back. And their dividend, through the price action, through all the ups and downs here, has stayed consistent. And it has grown. Okay? Now let's take a look at CIM stock. It paints the same picture it does with its dividend. Inconsistent, declining, and flatlining. Again, companies that are consistent, they show consistent growth. They meet certain financial thresholds, right? You're able to go in and check payout ratio. Why are they paying this amount? Why are they paying more money than they have? It shows the quality of a company, shows the mindset and the attention to detail that the executive board, the leaders of the companies have. Coca-Cola pays attention to things. CIM does not. Now, because CIM, you say, oh, well, maybe it's a little different. They're a REIT. They invest in different things. Sorry. Look at O, Realty Income Corp. Now, they have, it's in their name, income. They focus on the dividend, and that shows. Look at this consistent dividend growth. Now, the numbers are a little, different in terms of percentage growth, but look at the trend line. Up, 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 up. The dividend they've paid, $2.15 yearly, $2.19, $2.27. Skip a few years because you can tell it goes up, $2.96. There is an attention to detail. Now, don't get caught up in this number here. Okay, this number is calculated by a bunch of different things, and the way that they figure out real estate investment trust payout ratios are, a little wonky, but this is not good. Okay, this is inconsistent and up and down, and this is not what we want to see. This is what we would like to see. Now, don't go in and look at a stock and go, oh, the trend line goes up, I'm going to buy it. Okay, that there's more to everything, and that I think that's something that I've tried to display throughout, the dividend journey, really. If you look back at previous videos, we talk about payout ratio, we talk about all these other factors that also play in to a company. We even just, the last video, we compared Coke and Pepsi. Coke has shown, right, this consistent dividend growth. Pepsi has done the same thing, but they are two very different companies. They both sell, fizzy drinks, okay, but there's a lot more to Pepsi than there is to Coke, and Coke has a different distribution model than Pepsi. And so again, it is all of this investing, when you're actively looking into companies, when you're making decisions to be involved in independent or individual stocks, you have to look under the hood. Do a little bit more digging. Find out that companies are paying out more money than they have, and they're not raising their dividend consistently, and they're not paying attention to growth, and they're trying to pull you into, I'm all over the place, into a trap by raising a dividend to entice investors to invest and then dropping it right after. Invest in solid companies. Invest in companies that you understand, and invest in companies that show good trend lines up and have other factors that are going to continue their growth into the future, because good stocks can continue to show growth and pay dividends even when they dip down in here, and they can pursue, and they have good management, and they can make it out of things like this, and poor companies do not. So the big idea, the big picture of this video, do more research, look under the hood, and if you can't necessarily find that individual stock or company, Anchor your portfolio or make a majority of your investments within ETFs that diversify that risk for you. Because if a CIM was involved in an ETF, you're not going to feel the full pain of this just massive drop off. Instead, that could be counteracted by a stock like Coke that shows consistent growth and a stock like O that show consistent growth, and your dividend, or your ETF could show some growth within it, even with losers that are involved. So make sure you're doing research. Make sure you're looking into these things. If you have questions, leave them down below in the comments. I will do some research, get back to you, or make a video about it. And just remember, do your research, take looks, understand how the company can stand to make money and how they can stand to lose money, and always invest at your own risk. ETFs are your friend, and I will see you all in the next episode and the video on Thursday. Make sure to subscribe, hit the bell, stay notified, and leave a like.